So hard money lending or hard money loans are loans to an investor for the purchase of property to be paid back once the property sells. Now, usually these are interest-only loans that provide either monthly cash flow, or they could be structured where all the interest and all the principal is just paid back at the end of the project. But I guess my question is, at least when I started, was why would a reputable investor come to me or come to you to borrow money at double-digit interest rates, which could be ridiculous, rather than just getting a much cheaper loan from a bank? And I'll wait for a second. What do you think? In my mind, I'll tell you what I thought. I thought, well, these people all had terrible credit. They weren't bankable. They have proven they can't work with banks in the past, and that's why they're coming to me as a last resort. They're really, really risky investors. But the big advantage that you have over a bank, and why investors will choose you over and over and over again, is speed. To an investor, time is money, and banks can take up to 45 days to close a loan. And that is precious time that good investors just do not have. So if you're on this call, I'm sure that you understand the power of interest. So how can an investor justify paying you 12 to 15% interest on a loan? Again, speed. So if that investor can borrow $200,000 from you and your friends at a rate of 12%, really she's only paying 1% per month. She's not paying 12% every single month. It's only $2,000 per month that she has to pay you guys. So if she's really good at what she does and she can be in and out of that flip in like 8 months, think about it. That's 8 months at $2,000 a month in interest. That's $16,000 in interest that she had to pay just to lock up that house and get it done. But if she then turns around and makes $100,000 in profit on the sale, doesn't that make a whole lot of sense to pay 16% interest so she can make $100,000? Or $16,000 in interest so she can make $100,000? Heck yeah! So that's why it makes sense for them to pay these high rates, just so you can be in and out really quickly. You can work with them fast, you can negotiate quickly, and they can be in and out. But Walter, I'm going to go back to your original question. What about the risks? Banks have all kinds of fancy screening procedures and credit checks and a committee of people to make sure that they're writing good loans. I don't have any of that. Let's explore that a little bit. On your workbook, make sure that you pull out your workbook. Hopefully you've printed it because there's a lot of writing today. You should have a sheet that looks something like this. I think it's in a different orientation, but same deal. I want you to go through, we're going to walk through borrower A and borrower B. I want you to put a check by the borrower that you are comfortable lending to or more comfortable lending to, and an X by the borrower that you're less comfortable lending to. We're going to answer this question together. So borrower A has, let's talk about experience level. Borrower A has 0 experience in real estate, just moved out of his mama's house, and believes that now he should own a home. So that's what we're dealing with. Borrower B has been in this industry for 3 years. Not only do they have their own home that they're in, but they've been doing the real estate game for a while now. Borrower A is going to buy this house, but they actually want you to put up 90 to 97% of the market value of that home. Please and thank you. They're only willing to put in 3 to 10% of their own money into this deal. Whereas borrower B is only asking you to put up between 50 and 75% of the market value. Some of that is because they were able to negotiate a really low price for that property so they can buy it under market value. And some of that is because they're actually putting cash out of their pocket into this deal. So they're going to be sharing that risk with you. Borrower A, their plan to increase value in this deal is to sit and wait. Just hope for the best. But borrower B has a structured plan to force appreciation. Meaning they're going to put in new countertops, they're going to put in brand new floors, they're going to have beautiful new bathrooms, and it's going to take the value of that home from one price to a new price, and they're going to force that to happen quickly rather than just waiting for the market to change. Okay, now borrower B, their ability to repay the loan is based off of one job, just one. Borrower B has income from multiple projects. Maybe there are multiple flips going on. He's got a few rental properties. He's got some partners that he could borrow money from if he needs to kind of cover and get out of the deal. So he's got multiple options to get you paid back. And in terms of exit strategy, borrower A is gonna die. Like their plan is to buy this home, stay in there forever, and just that's the plan. Whereas borrower B has a structured plan. They're either going to sell or rent this property in the next 30 to 90 days, in and out. And all your money would be back in that time period. Okay. So you tell me in the chat right now, who are you more comfortable doing business with? Heck yeah, borrower B. It almost begs the question, who on earth would lend money to borrower A, right? So when we think about the three strategies that we have, who is this for? So first and foremost, you're going to need to have some capital today to lend out. So right away, you're in the if you're still in the cash raising phase, this is just not the right one for you. But if you were looking to park your cash somewhere and just let it grow, this could be an excellent option, especially if you don't want the monthly payments. So folks who are interested in real estate but are newer to the process sometimes lean towards hard money lending because it's a great way to earn while you learn. So for example, I have a couple that lends money, but they are really, really passionate about multifamily. And they want to be multifamily moguls one day, which is awesome. So when I bring them deals, I'm constantly looking at lending opportunities that are backed by multifamily properties. Because as a lender, they can require whatever they want. They can ask for quarterly meetings to hear about updates or quarterly statements to see how cash is moving in and out of the projects. So they started as complete novices lending money, and now they are actively looking to purchase their very first multifamily investment because they've done so many of them as the lender, they know what to look out for, right? So they've gained that extra confidence, and now they've been getting paid to learn. I mean, I would also argue, if you're looking for cash flow, this is particularly attractive because the entire monthly payment that you're going to get is pure interest, meaning that you can take those monthly checks and just spend to your heart's desire because your principal is intact. And the same cash will show back up in your account the next month like clockwork. So for my folks who have a hard time seeing these big checks come in and like, oh, I can't spend the principal, I can only spend the interest. Go with hard money. You don't have to do any kind of math, just it's better for you. Okay. So quick recap, the investment profile here. Again, I'm going to answer Everett's question one more time. The investment amount anywhere between $500,000 and $300,000, and that's really because we deal in vacant land so much. Our typical price point is between $20,000 and $40,000, but it can go as high as 300. Oops, sorry about that. Risk index is moderate, right? The term is relatively short, which lowers the risk, but you are dealing with an investor and the market could change. The market's changed rapidly in the past year. So yeah, there's a moderate risk. Typical return is anywhere between 9 and 15% per year with 2 points added on to that, 2 or 3 points added on. So a point is just a percentage of the loan that you charge as a fee. So for example, if you lend $1,000 to someone, you would charge 2 points. So that $200 would be your fee for giving them the money. Okay. That's on top of the interest that you earn in the year. Okay. The investment period, 3 to 12 months, because we're in the vacant land space, you can see some flips turn relatively quickly in 3 to 4 months, but I always plan on 12-month periods. Now, legal considerations, there are licensing requirements in different states. So especially for residential and owner occupied properties. So you may want to look into getting yourself licensed if there's certain states that you know you want to do business in. Otherwise, you could stay on the commercial side or with vacant land where the licensing requirements are much less stringent. And in most states, non-existent. Okay. So that's hard money lending.